Good afternoon or good morning, depending on which side of the country you're coming from. Welcome to McQueen Financial Advisors' our first webinar in our 2021 series. Thank you all for joining us. We're excited to have everyone here today. As we go to the next slide, I am Charlie McQueen, President of McQueen Financial Advisors. And I really want to personally thank all of you, all of our clients, friends, regulators, and the rest of the world that has joined us today. Thank you for joining us. I'm partnered on the next slide, you'll see, with Dan Martin. Dan Martin is our senior consultant who is actually running our valuations team and helping our transaction advisory group, and been doing an amazing job. So thank you, Dan, for joining us today.
Absolutely.
Thank you, Dan. So to kick things off here a bit, just some administration. As usual, feel free to submit a question anytime that you'd like. If you go to the bottom of your screen, you'll see Q&A. It will pop up. Go ahead and click on there, and we will review the questions and answer them. Feel free to ask them during the presentation and or at the end of the presentation. If you'd like a copy of today's webinar, please feel free to reach out to your advisor, and your advisor will send you a copy of the presentation. So with that, we've got quite the agenda today, and we're pretty excited. We're going to kick off with a little bit about us, obviously, which we've done. We're going to talk about the economic environment, which is really important in the M&A world today, as it's changing by the minute. We're going to talk about valuation drivers, bank M&A activity, credit union merger activity, credit union bank purchases. We're going to talk about some growth opportunities, and then head off to our 2021 outlook. So really excited. I want to thank everyone again for being here today. It's exciting here because we're going to talk quite a bit about things. Our M&A advisory component of the business has grown substantially, doing transactions of selling banks for banks, to banks, acquiring banks for credit unions, a trend we started many years ago, also branch transactions and other transactions. Along with that, we do a lot of asset liability management, investment portfolio management, and mortgage servicing rights valuations, and we can't forget CECL, one of our latest and greatest things, which we have to do for the regulatory world, but something we're actually really excited. We've got a great CECL product. So with that, one thing, Dan, we're fairly well ranked in the tables here, number 8 in the branch acquisition, and number 12 in the bank and credit union mutual M&A work. So the deal amounts are small because they're not disclosed in the credit union space, but we're pretty excited about the number of transactions. So with that, on this unique day today, not often do we pay attention to individual state runoff elections. We did have a big runoff election in Georgia today. Maybe you've not heard about it, but I bet everyone has. We definitely had a lot of interesting things happen with Democrats who appear to be winning 2 seats, and will take a majority in actually all areas of government, the House, the Senate, and the presidency, which has been a concern for a lot of people based off of the stock market and taxes. But the stock market today is really showing no signs of negative activity. It's really going well. We'll see where things go here, but the Dow is up 0.6% today, and the New York Stock Exchange up about 2.5% today. So it's definitely some positive activity. But a lot of changes coming with Washington and potential for regulation. So we're going to keep a close eye on that. So as we go to the next slide here, this is really one of the most important slides of the day. Those of you that have watched our economic updates on a regular basis, really interesting here. What this shows is that there has been a tremendous amount of money pumped into the economy. And that is the green line. That's disposable income. It's gone up more in 2020 than it has in 3 years combined up until this point. We've skyrocketed with the PPP funds, with the increased unemployment payments, all the different programs going on. And what that's done is that's put a lot of money into consumers' hands. At the same time, interest rates are low, amazingly low, I would say painfully low from a net interest margin standpoint. So we've actually seen that the dollar amount of debt, the amount that people have to pay on debt, continues to decline as 30-year mortgage rates are in the 2.7 range today. So really low mortgage rates, really low cost of debt. and people have more money than they've had in a long time. So we're seeing the blue dotted line, U.S. household debt to disposable income. We're at levels we haven't seen since the early 90s. And so we really see consumers in a great spot. And that really plays through when we see delinquency, lack of delinquency. But this also should remind us that our balance sheets are growing, which is making some capital ratios be painful, not from losses, just from the overall asset growth. As deposits come in, you have cash, which is an asset. Your assets and liabilities grow, and the ratio to capital is getting tighter. So that's something we're all going to have to keep a close eye on here. Look at the next slide. Things are also going well when we look at unemployment. Obviously, a pandemic is something that we haven't experienced for a long time now, so I'd say all of us haven't experienced. And what we saw was an immediate rush to unemployment, businesses closing in the first quarter, second quarter of 2020, and then the immediate rebound. And it's amazing to me that the United States, we're now down to below 7% unemployment. We're not at the 4 3/4, just below 5% range we were before, which one may say is not sustainable, but we've come crashing down substantially, which is good. We're back to I'd say a reasonable level of unemployment given the situation. But all is not fair. We've talked in our economic updates about the K-shaped recoveries. And the K-shaped recoveries, the good half is everyone, unless you're in the bad half, which the bottom would have a lot of travel, airline, those types of entities. So from here going forward, one of the best things we've seen in the market is the housing market. We've seen two things happen. One, if I'm stuck at home and educating kids and working from the house, I probably want a bigger house. And gosh, with interest rates as low as they are, great time to buy a new house. And so we've seen used home sales skyrocket to almost 7 million. And we're also seeing new home sales almost reach 1 million. New home sales have been painfully low for the past 10 years. And now they're spiking back to what we'd call some reasonable levels. This can't sustain forever, but we are also seeing some major demographic shifts of people leaving cities and moving to smaller cities or more countrywide settings. And so as we see this shift in the country take place, we'll probably see new home sales still do well and existing home sales still do well for quite some time. And low interest rates are definitely propelling things. One of the things people worry about with this is inflation. Do we have difficult inflation because of this? We are really going along at a low rate of inflation. Consumer price index, ex food and energy, one of the favorite things we watch is 1.6, PCE 1.38. The Fed has come out and said they are going to favor more inflation than less inflation. They understood what happened when we went into 2008 and 2009 and home values declined and deflation took place. That was bad. And so they're going to actually be encouraging higher rates of inflation than lower, which is one of the reasons why on our next slide, we start to predict interest rates and where we see interest rates going. In our last economic update, which was the end of last year, we talked quite a bit about rates low for the next 4 years. In March of this last year, we predicted rates low because of the coronavirus for 5 years. So we're getting towards our closer to 4 years now than 5 years. And if you look at this chart, the Fed funds rates, the red dotted line, 2-year treasury is the blue dotted line, and the 10-year treasury is the black dotted line. We're looking very similar, not necessarily where we were in 2008-9, but a little bit more like where we were in 12-13. We really have bottomed out on interest rates. We may see things start to tick up a little bit as they did today with the 10-year coming up actually above 1%. But I expect that interest rates are going to remain extremely low for the next 4 years, which is going to cause some problems from a margin standpoint. So with that, we do expect interest rates to remain low. We expect margins to be exceedingly difficult. We expect deposits to continue to grow. We're just getting the second round of stimulus checks in this last week and next week. And there's already a promise from President-elect Biden that there's going to be a bigger stimulus check coming out. So what that's going to mean for us as an industry is more and more deposits and potentially a little bit of loan decline. We've seen actually a lot of payoff of loans in the credit card area and other areas as people are flush with cash at this point. So with that, definitely a interesting economic environment. Stocks doing really well, extremely low rates on bonds, a lot of uncertainty with the coronavirus and a change of leadership in Washington. So that's our underlying environment in the current merger and acquisition environment economic update. Off to you, Dan.
Thank you, Charlie. Appreciate that. Kind of sets the background for a couple things I have to mention here. When we kind of look at, really the economic effect to the transaction space, I think COVID had a big effect. The interest rate environment we're in has a pretty big effect. Increasing margins, people are looking at their earnings and saying, where can I get more dollars from this year and really on a go-forward basis. So, COVID ultimately had the biggest impact on kind of what we saw from the transaction world. Most deal activity, really grinded to a halt end of the first quarter and through the second quarter as institutions across the country were really trying to figure out how to handle the situation at hand. We did see a little bit of pickup in the third and fourth quarters. Not the same kind of levels we saw in 2019, but better than the second quarter of this year as more institutions became acclimated with their process and kind of got things in line. So looking forward to 2021, I think out till probably at least June, we'll have a better first half than last year. However, I do expect it to continue to be a little bit slower as we kind of experience this vaccine rollout and the implementation of that. Looking at how COVID specifically has impacted, reasoning for acquisition or looking at mergers or acquisitions, really there's a lot more concentration on earnings, tighter margin environment, looking for ways to expand your non-interest income. These are all kind of things that people have been looking at. Another one, COVID for smaller institutions. A lot of people may have realized their lack of technology investment or the need for more, which has led to an increased interest overall in exploring the growth space. And as you grow, obviously you have efficiency gains through both technology and size. So a lot of reasons to look at mergers, but COVID has definitely brought some to the forefront. With that thought process, a lot of institutions, clients of ours, clients across the country have looked to use COVID in other ways, maybe looking at branching strategy or lending that maybe they should be doing. What do you do with all these surge deposits that you get? So it's been an interesting world. We continue to see, a decline in branches overall. So Charlie, I'll hand it over to you to talk about kind of that trend and what we've been seeing with new bank charters and branching.
Yeah, it's a great point, Dan. One of the things I do know, and we'll address a little bit, there has been some contention with sometimes with with credit unions acquiring banks. And one of the things I would like to remind and encourage, and we spend a lot of time with bank associations and encouraging here, is the number of new banks that has started was absolutely decimated after 2009. We actually went to zero for 11, 12, 14, and 16. There was, I believe, one bank in 13 and 15 and 3 and 17. We got up to about 10 or 12 and 20. This is really one of the biggest problems that I look at from a banking world. So we really need to make sure that we're thinking carefully about why are our new banks not opening and making sure that we're looking at regulation from a Washington level, not only a state level. I'd love to see more and more banks started every day, and that's something that a lot of small communities are missing, are the new startup community banks. I mean, we are averaging about 140 new banks a year if you go back 20 years. And that's a lot of new banks that just aren't around anymore. And when we go to the next slide, you'll see that the number of commercial banks continues to decline quite significantly. We're around 8,200 in 2000, and we're now down to 4,800. So huge, almost a 50% decline in the number of banks outstanding. And so if we we think about that, that's one of the biggest reasons why we're seeing these is if you start adding in 100, 150 new banks a year, that becomes some pretty big numbers that are now missing when you look at this over a 20-year time frame. About 2,000 banks. So it accounts for a chunk of the decline, about 50% of the decline. Go to the next slide. We are seeing, though, the same thing with credit unions, not almost as fast as the same decline. We went from a little over 10,000 to a little about 5,500, 5,700, sorry, 5,700 now. So credit unions have also shrank consolidation. And as Dan mentioned earlier, a lot of this comes down to is efficiency. There were a lot of small credit unions in the country. There still are in the below $50 million range. That can be extremely difficult. So one of the questions that did pop in on new banks, are there any new online banks included in this number? And yes, if it is a new bank, it is included. Now, Capital One has started an online branch. My understanding is that's the same charter. They're just doing a separate branding. But if any new bank that started that is using a new charter, that is the case. If someone is using an old charter, that is not the case. So just wanted to share that with the group. So fintech, which will become a bigger and bigger conversation here in the next couple of years, would be something to see if we see some more charters pop up for the fintech reasons. Now, next slide, we're not only talking about the number of banks and credit unions shrinking. What we saw after 2009 was the reversal of a trend. We've seen the number of bank and credit union branches in the country have been growing. And we grew all the way through 2009, and now we've started to shrink. And we went from a little over 107,000 branches, now down to about 90,000 branches. And one of the really unique things here that happened in the credit union space, for the first time, we actually saw credit union number of branches decline in 2020. Some of this may be pandemic related, but I think it's also maybe thinking about the next step of the fact that, I haven't been to a branch for a long time, and especially given a pandemic. So Dan, hand it back to you.
Yeah, I appreciate that. I think that kind of flows into, I really like this graphic on the right. We can see really since 2012, we've been at a net closure compared to new branches. And I think that goes right along with the line of thinking that people are revisiting their branching strategy. As a whole, we've seen smaller branches across the country. You mentioned Capital One earlier. They kind of transformed, or were in the process of rolling out their cafe style branches. Obviously, that probably didn't go over so well with COVID and no in-person banking. But that's a trend that I think we may continue to see moving forward. So when we look at kind of, where all the market share has gone in the past 20 years, I think it's really interesting to note, credit unions, they've continued to grow and gain market share here, going from 5% to 7%, that blue section at the bottom there. But really, the primary loss is in community banking, going from a 53% market share to 18.5%. Credit unions make up a small part of that gain, but it's largely the largest banking institutions just continuing to be the big gorilla in the room and gain market share.
And Dan, I think this is a great point where community banks and community credit unions really should be partnering in a lot of ways as they look at the market share. As much as it's declined, it's really the two industries are more aligned than they've ever been.
Yeah, great point. So flipping over, kind of looking, how can we combat that? How can we sustain continued growth? In our opinion, one of the best ways to look for growth is through acquisitions. And so starting at the basic level of why would I really continue, go and look at an opportunity for growth? It can do a lot of things for you: size, scale, really. If you want to go and expand in a new geographic region where maybe you don't have a branching network, but you're looking to be in a new metro area, if you're looking to expand and acquire certain lending talent. Maybe you're looking to, to grow your mortgage lending business, and some competition down the street is up for sale, and they have some power mortgage lenders that would be great fits on your team. Plenty of reasons to look at purchasing. Reasons that you might not look at an acquisition. Differencing in economic uncertainty. If they're lending on a bunch of hotels and travel industry type loans in this environment, that's obviously higher risk. So that can definitely turn you off there. Or, frankly, if you don't have the existing capacity from an internal standpoint, being able to undertake an acquisition, the integration of that, and having the capacity within your own organization to do so. Looking at, when we do look at acquisitions, we want to consider, what reason or what value do we get out of that? We can have reasons that we're interested in it, but what value are we really going to realize here? And I think, as we enter this margin environment where earnings are going to become ever more important, being able to add an earnings stream, typically, where you're going to get some cost savings and be able to enhance that earnings stream, is really only beneficial to your bottom line. So that's a really a big one. Again, geographic market, experienced team, those are great things. But another one that doesn't get talked about enough is really the relationship and wallet share component of that. So if you're a consumer based lender and you're looking at acquiring a commercial entity that does mostly commercial lending, you're going to have some crossover relationship gains there that often a lot of people just don't consider in an acquisition scenario. What you typically don't get, lack of flexibility, depending on the way you structure the acquisition, if it's a credit union purchasing a bank, for example, that's a dilutive activity to your capital ratio. So it does hamper you in that regard, but typically, with the increased earnings, you're able to grow that back pretty quickly. So once we've decided, hey, we're looking at an acquisition, this is something that interests us, typically what do we look for? How is a deal normally structured? What are the benefits really? So there's a couple things just to point out as far as why people do this. One, in almost all cases, you're going to make all your money back and more in 5 years or less. That's typically the back of the napkin math there. So if you're going to go out and build some branches, you might have a break even at 5 years, but to get all your money back, it takes you 8 years or something along those lines. So buying an existing business with an existing earnings stream and network, very valuable there. Also, there's a lot of cost savings involved. So if you're buying something with $1 million in earnings, you might have $1.5 million or $2 million on a go forward because you don't have all those back office expenses. Or there's, crossover sales that you can make via revenue enhancements to continue to build up that business.
Yeah, and that's, Dan, let me interrupt for a second. It's a great point. Today, one of the things that you guys have on the call heard me talk about for the last probably 9 months is margin and concern about margin and non-interest income. And I look at if you're not in the SBA business today, it might be something you want to get in, or if you're not in the mortgage business today, it might be something you want to get in. And sometimes an acquisition is a easier way of doing it than starting from scratch. And we also have to remember that if you acquire something smaller than you that has an expertise, you can roll it out and bring it into your organization, which can give even more potential positive revenue.
Yeah, appreciate that, Charlie. One thing I would point out, it's not all golden rainbows. There are obviously some things you have to consider when going through transactions like this. You never want to overlook the cultural synergies. You never want to go into it expecting to cut more costs than maybe what you're projecting. That sets you up for a bad situation moving forward. So definitely some things to consider there. Finally, if there's a couple differences between looking at an entire acquisition versus branch acquisitions. From a pricing standpoint, a little bit different. Cash and stock is typically how you may buy a community bank today. Branch acquisitions are typically priced on premium of deposit, so it's percentage over overall deposits. A couple other interesting differences. When you look at the facilities being acquired, you may pay book value, you may pay market value, kind of depends on what's negotiated there. So that's typically a little different. And then also when we look at actually accounting for the transaction, typically a branch transaction is just going to result in a large goodwill amount to be booked on your books. So something to be considerate of as you look at different opportunities.
And Dan, I'll add that it's deposits are plentiful today, and branches are closing. So the branch deals are still very viable and still really good to do, but you also have to be very thoughtful on how it fits and have a rationalization of why you'd want to do it. And the premium's down a little bit.
Right.
Before you go to the next slide, which is a really important one of importance of scale, a question that came in was really, how do I get in front of the right people? What's the best approach for identifying an acquisition opportunity and really be the first one at the table? And what we've seen from this is there are two ways. One is, I'd say, be who you are and be out in the marketplace and know everyone that you'd like to merge or acquire. Make sure you know them from a friendship relationship. Make sure you're spending time with them. And then number two is reach out to us. We'll run a targeted search program and talk to people for you. It's something to think about as we think about growing deposits and growing loans and adding branches. It should be a fairly specific activity that you take on with a focused opportunity. So with that, I'll hand it back to you, Dan, and you can hit on a scale here because this next slide is really an amazing slide.
Yeah, I appreciate that, Charlie. As we look at, size of organizations, I mean, there's one thing that's very evident is the more you grow, the more efficient you become. And a lot of that can be seen when we look at acquisitions, the cost savings, the revenue enhancement, all that really leads to this. And I think this is an excellent picture that just shows the benefit of growing through acquisition. As you get larger, you become more efficient. Here's another one. This is looking at kind of delinquency ratio and return on assets, a little bit convoluted on the over 10 billion on the far right here, but still generally a increasing ROA. The larger you get, you continue to gain those operational efficiencies and then typically have less delinquency. So before we go into this next section, I'd love to remind everyone, as we talk about pricing, obviously every deal is unique. You have to look at all the individual characteristics of the institution you're looking to purchase or acquire, because headline numbers are one thing, but getting in and digging into the details is where the pricing really becomes important. So with that, we look at total bank M&A trends from this year. Deal value down significantly from last year, as you might expect. There's just less activity going on in the world with COVID, and therefore we had less total dollars trade hands. So if we look at some of the largest transactions of the year, Huntington Bancshares and TCF here in Michigan was the largest transaction of the year. This is actually the second one that TCF has done. They merged with Chemical Bank recently as well. So they've been doing very active in the space. A couple other big ones near the $10 billion size, South State Corporation, Center State Bank down in Florida, and then Pacific Premier and Opus Bank in California. But we've definitely seen a trend with some larger deals in the last couple of years that is looking like it's something that might continue.
And that really goes down to the efficiency, and as people looking to become more and more efficient, given these tighter margins. So, thank you, Dan.
Absolutely. So here you can see again, based on total number of deals, we're roughly half of where we were last year. And just to kind of give a little idea of where these took place throughout the year. In Q1, we had 45 total deals take place. In Q2, that dropped to 10. So like I mentioned previously, world kind of fell off a cliff there. Everyone put the brakes on hold. and really slowed everything down there. So here, this is the most recent transactions that have been announced. So here we have 4 that happened in December. There's a handful more pending for January. We can see that Huntington is the biggest one of the group here, but continue to expect some deal flow through the first half of this year, but again, at a slower pace than pre-COVID. So this is everyone's favorite way to back of the napkin, cocktail napkin math of looking at bank pricing. So is the price to book ratio, overall 2019 was about a 1.5 times equity. We dropped below that in 2020. We saw that reflected in pretty much all of our deals. There's increased risk due to lending. People just aren't willing to pay the same premiums. A bank that might trade at a 2 times multiple in 2019, you're probably looking at a 1.8 this year. So definitely some declines in the premiums we've been seeing on deals.
And the thing to always remember here is I think Dan said it well, cocktail party number. The real key here is earnings. And when looking at the earnings, and if margins are getting tighter because interest rates are so unbelievably low, that's going to result in reduction of prices because of the earnings capacity. And this will also make entities that have SBA and mortgage lending and good sources of non-interest income more valuable than those that don't not. And we'll really begin to see a bifurcation of pricing, or we should see a bifurcation of pricing based off those 2 types of institutions.
Yeah, I appreciate that comment, Charlie, because earnings are an important component there, but also, kind of geographic region here. So if we look at pricing, between the Midwest and New England, for example, just looking at different geographic regions, we have 53 transactions that took place in the Midwest region this year at a 1.3 times book ratio, whereas we had 3 transactions take place in the New England region. So there's a huge disparity. People pay premiums to be in premium locations, the coasts, large metro areas. So there's a geographic component to that pricing as well. Here we can see another example of this. A 1.08 times book multiple in the West, but we only had 4 transactions. Where in the Southwest, we're at about a 1.3 with 16 total deals. So really just a big disparity. So then that was all looking at whole bank deals, looking at just kind of how branches have traded this year. Kind of in line, a little bit above 2018, very small number. A lot of uncertainty going on this year. Stimulus deposits have made branches, people in the past may have gone and acquired branches for liquidity. We're not seeing that as much. Obviously, everyone's flush with deposits right now. So one of the drivers of acquisition of branches is on the downside there. But it's definitely a unique year for branch transactions. And then we look at kind of pricing of branches, as you might expect, right in line with whole bank transactions. We're significantly below last year as the need for liquidity and branch strategy changes.
Yeah, it's an interesting slide there, Dan, because it really leads into what's happening here in this page. Asset growth has primarily been by deposit growth, as we talked about earlier today. And as we see this continued asset growth through deposit growth, it makes you think, is it a viable, valuable growth? Now, we talked about earlier, scale gives us more income. Scale helps us. But there is a point where if you're bringing in deposits at a higher cost, where you can't deploy them, you actually you come to a spot of negative earnings as you continue to grow. And so we've seen a lot of banks where we can actually start to see now the slowing of the asset growth in banks, and we've seen banks be a bit more proactive in cutting deposit rates, and we're still seeing a continued asset growth in the credit union space. And I would expect to see credit unions to be a bit more aggressive in cutting costs. We're heading back to the days of 1% or 1 basis point and 2 basis point yields. And I fully expect that we're really going to see deposit costs continue to come down. But this asset growth is good because, again, it's a very good efficiency, but it's also very difficult when lending is tough. Hard to lend in a pandemic, easy to take loans in a pandemic. Now, if we look at the next slide, sorry about that. Looking here, what's happened. This is a bit about growth of loans, and now the credit union industry, we've actually seen some decent loan growth in commercial. We've seen a lot of credit unions getting into the commercial space that have been out of it, and as a lot of these larger bank mergers take place, sometimes the smaller commercial loans fall out of that bank's sweet spot or sweet size. We've also seen credit unions get more involved in student lending and mortgages. Obviously, we all know what's happening with mortgages. But as I mentioned earlier, credit card balances are declining, and auto loans, typical sweet spot, have been really, really slow in this environment as there's been some issues with growing that. Going to the next slide, this is something that I'm extremely passionate about, and we spend a lot of time talking about earnings. Non-interest income absolutely has to grow. And we're seeing non-interest income grow as in both the credit union industry and the bank industry, based off of gain on sale of mortgages, number one, and number two, PPP loan fees. Really what concerns me is I think 2021, actually, a lot of people are going to have a hard time believing this. I think it's going to be a good year. And 2021 will be a good year because of the continued income from gain on sale of mortgages and PPP loans paying off or getting forgiven, and that fee income coming in. What I worry about is if interest rates start to go up, 20, 30, 40, 50 basis points, and PPP loans end, and then we're going to be a spot where earnings are going to be really tough. So making sure you're thinking about non-interest income and ways to be prepared for this for the long run.
So considering that, we've talked about acquisitions, talked about the importance for non-interest income, and, looking back kind of at acquisitions, when we look from a standard M&A activity, that typically is going to be a merger or paying to acquire something. And so we've just looked here. I think this is a very clean, easy way to look at acquisition strategies. Cheapest, easiest way to do it is two institutions merge. As you go down the list of more expensive, acquiring branches, buy an existing institution, and then when we look at starting a new branch, while the total dollar amount may be cheaper than purchasing an existing institution, the payback of the funds invested is the longest when starting a new branch. So here are just some non-typical growth opportunities we've looked at for clients. Mortgage companies with the mortgage market on fire this year. That continues to be a good space to potentially expand into. Credit union specific QSOs, a lot of opportunities there. You can purchase one, you can form a new one, purchase part of one to expand your capabilities. Insurance company, wealth management companies, title companies. You could look at obtaining trust powers. A lot of ways to grow. Doesn't have to be just your typical loans and deposits. So here's a trend that was on a up and up, if you will. Through 2019, credit unions bank purchase activity was at an all-time high. This year, due to COVID, we had that drop off. I would expect 2021 to probably be higher, more transactions than 2020 as the second half of the year. Restrictions are less in place, and everyone's appetite is more open to this type of activity. And then if we just look at those 5 transactions for the year, United Federal with the largest, acquiring Edgewater at $228 million in assets. Funny enough, 3 of them were actually in Indiana, but good to see continued activity in the space. When we look at transactions, a couple slides here that talk about the biggest difficulties or obstacles in doing any transaction. And really, the number one here is finding a partner. It's definitely a difficult activity. It helps to have a lot of friends in the industry. You know, your community organizations, credit union leagues, banking leagues, those types of things. You can have very informal conversations. A lot of conversations start there. If that's not something that you are able to do, you know, that's something that we can definitely assist in. Operational cultural issues are the second biggest one. You know, having two management teams that are on the same page or have the same belief system is really big in looking at any of these activities. And then finally, why should you really acquire? I mean, we've talked about it a couple times here. Economies of scale, you know, really just facilitating that growth. The graph on the left here, I love. You look at credit unions that have gone out and acquired institutions are just growing at a significantly faster clip than those that have not, both in deposit growth and membership growth. So I think this illustrates it nicely that being acquisitive is very beneficial to your institution.
So Dan, it's some good information. And, you know, as I think about a lot of things we've talked about today, and this is merger trends and acquisition trends. And what we've talked about today is we've seen a rebound. The second quarter of 2020 went from a whole bunch of stuff to nothing with the announcement of COVID. Third quarter came around a bit of trying to figure out how to do due diligence during a pandemic. Are we going to have loan problems? A lot of people are predicting loan problems in the fourth quarter. And as we look forward, we think that there's a ton of pent-up demand, so we should see some activity. Obviously, the rollout of COVID-19 vaccine, the political environment, all the different components may make things slower for the first quarter, but we'd expect to continue growth in the second quarter and then onward into 2021, as definitely the margin environment makes things tough. We may see a little bit of a slowdown due to capital ratios, but as many of you see out there, there's a ton of secondary capital offerings happening in the bank space and a growing amount in the credit union space. But there's a lot of money out there to be able to bring in for some sort of secondary or debt-based capital at a holding company level. So keys to success, you know, get a good strategy. Really, that's the first thing. Make sure you have the strategy, what you want to do, where you want to go, and then think about, you know, strengths that you need and strengths that you have. And what can you do to take 1 + 1 and really make it 3? It's one of the big keys. And, you know, I think that as things change, we also have to change. And in the comment here, you've done things before. We have to think about the changing environment, size of branches, location of branches, how branches work. And then in the end, I think we need to really plan on proactively communicating, but also now on top of this is growing into communities where you want to be and where we're seeing growth in the number of people or a vacating of other institutions leaving a market when a large transaction takes place. And so looking at that, looking opportunistic, we're all going to read a lot about people leaving New York and cities and moving to different areas in Florida and North Carolina and Texas, and thinking about those population trends. You might not, for your institution, be thinking about trends into different states, but you may be thinking about different cities inside the state that you're in. So I definitely think that's something we're all going to think about. So as we go into 2021, what's really going to happen here is, you know, there's going to be some tough things happening with COVID-19, the rollout of the vaccine, and how things happen, and that's going to cause some uncertainty. And again, doing due diligence during a pandemic is not easy. From there, I do expect deposit growth to continue. President-elect Biden has stated that he is going to go from $600 to $2,000 a person. And so we are going to see more cash come in, and the PPP programs coming out for another round. Regulation's probably going to get tougher. If we look back to the last time we had this type of administration, regulation on our industry got worse. I do think we're going to continue to have pressure from fintech. And that's why sometimes the larger institutions feel that they're going to fare better because of that efficiency in the attacks from the fintech world. And then in the end, given how low interest rates are, and I know I'm a broken record, you guys have heard me say this over and over again, non-interest income is really going to be the key to success. So with that, I'm going to pause here. We've got some questions that have come in, and we're going to answer them. And you can flip to the next slide, Dan. One of the questions that came across here is banks have become very comfortable with really large mergers, and credit unions have not been as comfortable with really large mergers. What is the why is that, number one? And then number two, are there asset size targets that are sweet spots for any given size? And so I'll take these and break these into two, and I'll answer them, Dan, if you want to add on. I think banks are more comfortable with the large mergers, frankly, because they're looking for a shareholder-based return and looking to grow faster into a large geographic area. And as many of you know that have done any sort of merger or acquisition, it doesn't really matter the size. The tough things happen. The tough things are the database conversion, core processing conversion, the online or the other additional technology contracts that get put together and databases that get put together. If you're a $10 billion institution or $100 million institution, it's tough either way. So I think that's a bit more there, and I think the banking world is a bit more open to just whatever's going to give the shareholders the best return. From a sweet spot standpoint and target sizes, if you're looking at acquiring something, obviously capital and your capital constraints are going to be your guideline of sizes. So for me, I look at this as not as much as a size conversation as a uniqueness. Is the entity I'm looking to acquire in the market I really want to be in? Do they have products that I don't have that I really want? Do they have these things that I really want that make sense and bring it together? Dan, do you have other comments on that?
I think those are some good points. I'll actually answer another question with my comments here. There's a question on kind of transaction costs when looking at these. What all is being considered here? You mentioned data processing contracts. Typically there could be an expense there. Employees are important to look at, understanding who fits in your organization, where they fit. There may be employee contract expense there. Vendor overlap, any contract buyouts from that aspect. Facilities, understanding your branch network, what it's going to look like post-acquisition. And then, your standard advisor fees, whether that be legal, accounting, that sort of thing. So hopefully that touched on some of what you're looking for as well.
Yeah, thank you. So another question that came in, a really good question, and it asked about unemployment. And it says that unemployment is showing improvement. Do you know how much that improvement is due to people dropping out of the workforce because they stopped looking for work? And what's the thoughts behind that? And we did a little bit of research, and obviously unemployment is something really important. And when thinking about unemployment, it's important to think about the major demographic changes that are taking place in the baby boomers retiring. But to give a little context, the unemployment rate hit a 50-year low in Q1 of 2020. We're at a 50-year low. And at that point, the labor force participation rate was at 63%. Now, it did drop the participation rate to 60% in April, which is one of the lowest it's been since 1973. And now it's back up to basically 62. So we've come off that low point. We're almost at the same participation rate. And so we think it's a little bit of it, but job openings are still plus 4.4% year over year, which is basically a 10-year high. And one thing I'll add, I did go out 2 nights ago to get dinner to go, and I saw 2 help wanted signs. Hard to believe that being a pandemic, you'd see help wanted signs, but I actually did see help wanted signs. So I think there's more to this with a retraining that may have to take place and people in jobs that are forever gone. But the unemployment rate is, I think, doing actually much better than what a lot of people think from headline news and numbers, which is one of the reasons why I believe the stock market is doing as well as it is because the unemployment rate is as low as it is and the amount of cash in the system. All right, Dan, do you have any other questions that have come into you?
Nope, that's it for me.
Okay. Well, that wraps up the questions that we have today. I want to thank everyone for attending. Really appreciate everyone coming and spending some time with us here today. Our next webinar is on January 27th, coming up here in about 3 weeks at 2 to 3 p.m. Eastern Standard Time. We're going to be doing our Q1 economic update, and you'll start to see that link come out this next week. This Q1 economic updates is actually going to be very interesting and I think quite important for the year. We obviously have a lot of things happening. We'll know much more about the speed or the lack of speed, as those of you who read my economic updates, weekly economic updates, know my frustration with the state of Michigan and the rollout of the COVID-19 vaccine. But we'll see what happens there. And then the other component too is we'll have the Biden administration seated and know a bit more about what we should expect to be coming from there. So we think all of that will really help give us a good insight for looking at interest rates and the economy coming on over the next few years. So with that, I want to thank everyone for joining us. Thank you. Have a wonderful, productive, and hopefully a much more socially open 2021. Thank you, Dan, for the help also today.
Thanks.